Hello everyone, and thank you for taking the time to watch this video. It's Wednesday, February 5th, 2025. In a few minutes we will review the US tariffs updates and their impact on FX exchange rates. We will also cover the jobs report, including the non-farm payroll and the unemployment rate. Next, we will review the CME FedWatch tool and see how the current market conditions and the forecasted data may have impacted the 2025 interest rate expectations, and end with an overview of Euro-Dollar and Dollar-Yen technical analysis. For more in-depth analysis, please consider registering for our live webinars. The schedule and the registration links are in the video description. Before we proceed, we must understand the risks involved in trading. Please take a moment to review and read carefully the disclaimers on the screen. Please remember that trading involves risks. Past performance is not indicative of future results, and losses can exceed deposits. First, we start with a quick recap of what happened last week and earlier this week. On Friday, President Trump announced tariffs on Canada, Mexico, and China to go into effect on February 1st. The three countries vowed to impose their own tariffs in return. The news caused the US dollar to strengthen against major currencies. The chart we are looking at shows how the US dollar rose against the Canadian dollar, and this next chart shows how the US dollar rose against the Mexican peso. On Monday, following negotiations between the US President, the Mexican President, and the Canadian Prime Minister, agreed to postpone the tariff implementation to take place on March 1st, which led to the reversal of the US dollar as it erased all the gains which made against the Mexican peso, the Canadian dollar, and other currencies as well. We can clearly see how FX rates can be sensitive to any news updates on the tariffs. Moving on to the next topic, the US non-farm payroll, which is due on Friday. Please consider registering to attend our live webinar, which starts at 8 a.m. Eastern Standard Time, New York time, and runs through the news release in real time. According to the economic calendar and the Bloomberg analyst surveys, the forecast is at 170,000 jobs for January, which would keep the numbers within its 2023 and 2024 averages, as we can see on the screen. The breakdown also shows that sectors or most sectors remain consistent with their averages. This morning we had ADP employment change. The numbers came at 183,000 jobs, higher than the forecast of 150,000. We also had a revision for last month's release to be 176,000 instead of 122,000. The unemployment rate is also due on Friday, and according to the analyst surveys, it's also expected to remain unchanged at 4.1%. Now we can look at the CME FedWatch tool and see the most recent updates following the tariff news and the released economic data. The overall market data remains solid in general. We have strong economic growth. We still have a strong job market, steady inflation rate, although it's low, however still higher than the Fed's target of 2%. So the CME FedWatch tool shows us that 83 of market participants expect rates to remain unchanged for the upcoming FOMC meeting scheduled on March 19th. And as we look further into future FOMC meetings, we can see that the majority of market participants are looking for rate cuts to happen in the second half of 2025 rather than the previous view which we had in December of last year. First, we look at the overall context of price action through the weekly time frame on euro dollar. As we can see, we have a descending channel where price has been trading since early 2021. And when we zoom in on the chart to see the most recent price action, we can see that following the decline, we've been trading in a sideways range where price found support at this level multiple times in the past. Following the US elections, the euro dollar broke below an intermediate declining trend line, the dotted red line we see on the chart, and resumed its drop to reach this support level. Attempted to reverse back up, and then following the tariff news we saw euro dollar falling back down, and then again it rose back up, as we can see on this week's candle, after or following the agreements to delay the tariff by 1 month. The daily time frame shows us that price action has been trading within a descending channel which began back in September of 2024. Price action also broke below a horizontal channel support which goes back to early 2023, that's this green line on the chart. Attempted to reverse and break back up above this line multiple times. However, it only worked out in January or late January of 2025 when price action broke above the horizontal channel support line. Following this, we had the tariffs news and price action fell back down below the horizontal line, as well as began to trade back in within the descending channel where it was trading in the past. Following the agreement to postpone the implementation of tariffs, price action rose back up again, as we can see over the past few days, and currently finding resistance with its at a weekly pivot point, and which is the same level as the horizontal channel support we spoke about. Now we look at USD JPY, the weekly chart. The overall context of the chart shows that USD JPY has been trading in an uptrend since early 2022 when the FOMC, the Federal Reserve, began to raise interest rates on the US dollar. Price action continued to trade around trend line 1 and trend line 2 as marked on the chart, and the most recent price action shows us that we had a double top formation and a baseline indicated by this red line. Price action broke below the baseline where it's kindly at a confluence of support represented by an intermediate moving average, the MA21, and the annual pivot point of 152.91, as well as a monthly support level 152.98. The daily time frame for USD JPY shows us the most recent price action. As we can see, we broke below an intermediate trend line, attempted a pullback. Price action continued to trade within a range as highlighted in yellow color, and then by mid-January, price action broke below its 3 moving averages, 2 fast moving averages and an intermediate one, and have been trading below the averages since then. It also broke below its monthly pivot of 155.93, as well as its weekly pivot of 155.05. Currently, price action is nearing a confluence of support represented by S1 or support level 1 monthly and S2 weekly based on the standard calculation. Once again, thank you for taking the time to watch this video. Please consider to register for our live webinars for coverage on the major news events in real time. Thank you.